Welcome to the Deep Dive, where we take your pile of information and unearth the most fascinating insights from across the globe. Today, we're plunging into the complex and often surprising world of global oil demand and supply. You might think the story is pretty simple. EVs are rising, oil's on its way out. But what if the data tells a far more contradictory and, frankly, more interesting story?
That's exactly right. For this deep dive, we pulled from a really rich set of sources. We've got extensive analysis from the International Energy Agency's Oil 2025 report, some insightful market commentary from Forbes, and even some lively discussions from various Reddit threads that offer, a ground-level perspective. Our mission is really to cut through the headlines, challenge some assumptions, and truly understand the intricate forces shaping the future of energy. You might just be surprised by how multi-layered the picture becomes when we look beyond those surface narratives.
Okay, let's unpack this, maybe starting with China. A nation frequently cited as, the undisputed leader of the electric vehicle revolution.
Good place to start.
On the ground, Reddit comments really capture this shift vividly. One user noted noticeably more EVs just everywhere, and their Didi rides, China's version of Uber, were almost exclusively electric. Apparently, you can spot them easily with their distinct green and white license plates.
Right, those green plates.
Some of these discussions go even further, with claims that China's rapidly expanding EV fleet is already displacing over 1 million barrels per day in implied oil demand. And get this, that EV sales are expected to overtake traditional internal combustion engine cars maybe as early as next year. That's like a full decade ahead of some initial forecasts. It sounds like a monumental shift, suggesting a dramatic drop in oil demand.
It really does sound huge, doesn't it? And what's fascinating here is that while EV adoption in China is indeed accelerating at what the IEA calls breakneck speed, the overall picture for their oil consumption is much, much more nuanced than that simple displacement narrative suggests.
Okay, how so?
Well, the IEA's Oil 2025 report indicates that China's total oil consumption in 2030 is now set to be only marginally higher than in 2024. Marginally higher. Now, that might sound like a plateau, maybe even a slight peak, but here's where the data becomes truly revealing. One Reddit user, citing official figures, points out that oil consumption in the PRC actually increased. It increased by more than 1.5 million barrels per day in 2023 compared to 2022. That's a big jump.
Wow, 1.5 million barrels up.
Exactly. And even if it's projected to dip by, say, 300,000 barrels per day in 2024, that still leaves it up more than 8% from 2022 levels. So it's definitely not a straight line down. Not at all.
That really is the contradiction, isn't it? How can EV sales be soaring, displacing millions of barrels potentially, yet overall oil consumption still climbs, or, at best, barely plateaus? What's the underlying dynamic at play? What reconciles these seemingly opposing trends?
That raises an absolutely critical question, and it's about the primary energy source for these EVs. The same Reddit thread, quoting Newsweek actually, highlights a key factor. Most Chinese EVs are powered by coal. It's a fact.
Coal.
Right. Now, while it's true that large coal power plants are significantly more efficient than individual car engines, maybe 35% efficiency versus 15-25% for combustion cars. And yes, many EVs do charge during off-peak hours when grid demand is lower, which helps. But China has simultaneously been building a truly staggering amount of new coal-fired power capacity.
Staggering how?
The IEA data shows China accounted for a whopping 95% of all new global coal capacity in 2023. That's about 48 gigawatts net added. Just to put that into perspective, 48 gigawatts is roughly enough to power over 40 million average U.S. homes.
40 million homes worth of new coal power in 1 year.
In 1 year. And the trend continues. There's another 70 gigawatts currently being built this year. So this clearly suggests a double-tracked energy approach. They're expanding renewables, yes, but also coal. Both are expanding to meet rapidly growing energy demands, largely driven by industrial growth and just general electrification.
So it's not either, it's both hand.
Pretty much. Although, it's also worth noting a recent policy shift. China apparently abruptly curtailed approvals for new coal power plants in the first half of 2024. That showed a significant decline compared to 2023 figures. So this could signal a potential reevaluation, or maybe it's just a pause after such massive additions. We'll see. But the key insight here is that China's energy transition isn't a simple pivot. It's a complex, simultaneous expansion across multiple energy sources to fuel immense economic growth, and that's fundamentally reshaping the global energy mix.
Okay, that's a really fascinating and, yeah, complicated picture for China. Let's move west then. Some sources, maybe some headlines, have suggested that Europe and the U.S. might be abandoning the rapid EV transition, or maybe have fallen behind due to various factors, political influence, consumer resistance, that kind of thing. What's the reality here, according to the latest IEA data? Are we seeing a similar kind of nuance?
Yeah, if we connect this to the bigger picture, the IEA's data presents some truly unexpected shifts, particularly for the United States. Really unexpected.
Yeah.
Contrary to earlier assumptions of a swift decline in oil demand because of EVs, U.S. oil demand in 2030 has actually been upgraded by a substantial 1.1 million barrels per day compared to just last year's forecast.
Upgraded, so more oil demand expected, not less.
Exactly, more. And this significant revision is primarily attributed to a few things. A more optimistic GDP growth outlook, persistently lower pump prices than they anticipated, and what the IEA describes as a significant loss of projected momentum in EV adoption.
Loss of momentum in EVs. That sounds significant.
It's quite striking. Electric vehicles are now expected to account for only 20% of U.S. total car sales in 2030. Just 20%. That's a dramatic decrease from the 55% they assumed just last year in the previous forecast.
Wow, from 55% down to 20% projected share in 2030. That's a huge revision.
It really is.
Okay.
It suggests that the pace of electrification for personal transport in the U.S. is far slower than previously modeled, and that obviously has big implications for gasoline consumption for years to come.
So the U.S. economy is maybe stronger than expected, people are driving more, and consumers are buying fewer EVs than previously thought. And that translates directly into significantly higher projected oil consumption. Are there other factors at play here beyond just EV sales, like broader lifestyle or efficiency trends?
Precisely. Yeah, the IEA's analysis also digs into those broader shifts. For instance, while teleworking, working from home, gained broad cultural acceptance, especially in the U.S., and that contributed to fewer miles driven per dollar of economic output.
Right, less commuting.
Exactly. But that trend doesn't completely offset the other factors. It had an impact, sure, but it wasn't, a silver bullet.
Yeah.
U.S. gasoline use did fall about 4% below 2019 levels in the 2020-2024 period, but a significant chunk of that reduction can also be attributed just to improving vehicle efficiencies.
Cars getting better mileage.
Right. New vehicles in the U.S. jumped from an average of 24.9 miles per gallon in 2019 to an impressive 28 miles per gallon in 2024. That's a measurable improvement. It reduces fuel consumption even if you drive the same distance.
Okay, and what about Europe? You mentioned it's different there.
Yeah, Europe presents a different trajectory. Its oil demand actually peaked back in 2022, and it's now forecast to contract by an aggregate of about 730,000 barrels per day through 2030. This decline is mainly in industry-linked fuels like naphtha and gas oil stuff used in manufacturing industrial processes. And that's largely due to subpar GDP growth across the continent and a kind of sustained shift away from diesel vehicles.
Interesting. And what about that story about Germany going back to coal?
Yeah. That was widely reported at the start of the Ukraine war. But the reality, according to the IEA and other sources, is more nuanced. They basically held some coal plants on standby, just in case, for grid stability. But they never actually switched them on in a major way. Instead, they actually continued to retire more coal capacity during that time. So again, the narrative we hear isn't always the full complex story.
It really shows how significant these regional variations are.
Okay, let's zoom out then to the global energy landscape. What do these diverging trends, China, the U.S., Europe, what does it all mean for overall global oil demand and supply in the coming years? Are we heading for a shortage? Or maybe something entirely different?
Well, what's fascinating here, globally speaking, is that the IEA forecasts global oil demand to rise. It's projected to rise by 2.5 million barrels per day from 2024 to 2030, reaching a plateau around 105.5 million barrels per day by the end of the decade. But crucially, this growth is strongly front-loaded.
Front-loaded, meaning?
Meaning most of the growth happens soon, and it slows significantly after 2026. This might surprise some people, but the underlying drivers are quite clear. This growth is almost entirely propelled by emerging and developing economies. India alone accounts for a monumental 1 million barrels per day increase. That makes it the largest single country contributor to demand growth.
India, okay, and the developed world. In stark contrast, oil consumption in the OECD countries, the more developed nations, is actually forecast to decline by about 1.7 million barrels per day over the same period. And that reflects greater efficiency gains, fuel economy standards, and shifts towards other energy sources in those regions.
Okay, so demand growth is slowing overall, peaking maybe around 2030 and shifting geographically towards developing economies. But what about the supply side? Can producers keep up with even that slowing demand growth? Or are we looking at a different kind of challenge entirely, maybe an oversupply?
This raises a really important question about investment and capacity. And it's kind of paradoxical. Despite all the global efforts to transition away from fossil fuels, global upstream oil investment, that's the money going into exploration and production, it's actually set to fall by about 6% to around 420 billion US dollars in 2025.
Investment is falling.
Yeah, falling. Some of the largest declines are expected in light tight oil, which is essentially U.S. shale oil from fracking. However, and this is where it gets really interesting, overall world oil production capacity is forecast to rise by a substantial 5.1 million barrels per day, reaching almost 115 million barrels per day by 2030.
Wait, investment is falling, but capacity is rising significantly. How does that work?
Well, the capacity growth is primarily led by projects already underway or committed, particularly by Saudi Arabia and also the United States, despite the dip in shale investment. And this significant increase in capacity, 5.1 million barrels per day, as the IEA explicitly states, significantly outpaces the projected 2.5 million barrels per day increase in global oil demand.
Okay, significantly outpacing demand.
Yeah, so this points towards a potential oil surplus on the horizon, a scenario also highlighted by Forbes.
More capacity than demand. That certainly sounds like a recipe for an oil glut, as they say. What does this mean for market dynamics, and how are the major producers, like OPEC plus us, responding to this potential scenario?
It absolutely points in that direction. And this isn't just a market blip. It could be a strategic game changer. We're already seeing some movements. OPEC plus, led by Saudi Arabia, has started slowly unwinding some of its oil production curbs. Now, this initial unwinding actually pushed oil prices down to four-year lows back in April and early May 2025 before geopolitical tensions caused a rebound. But despite those short-term fluctuations, their broader production policy is still aimed at, tightening crude markets to support prices.
But a looming surplus makes that harder, right?
Yeah, exactly. It could really challenge that long-term strategy. And look at Saudi Arabia, for example. They seem to be strategically shifting their focus domestically. They're emphasizing natural gas resources and renewables to reduce oil use in their own power generation. This allows the country to maintain its huge crude oil production capacity, but frees up more of its valuable crude for potentially more profitable exports. Exports into a market that, as we said, may soon be awash in supply. It's kind of a move designed to protect their market share and revenue in a changing landscape.
Interesting strategic play. Okay, shifting gears slightly, but still related. Beyond crude oil itself, our sources highlight a major, but maybe often overlooked, shift happening within the refining industry, and also the growing importance of something called natural gas liquids, or NGLs. What's behind this, and how does it reshape the energy landscape? It sounds like a quiet revolution happening in the background.
Yeah, it really is important. If we connect this to the bigger picture, the refining industry faces, tepid growth is the IEA's term for traditional refined products like gasoline and diesel. Those are actually projected to decline in many markets, largely due to electrification and those efficiency gains we talked about.
Okay, less demand for gasoline and diesel.
Right. But this contrasts sharply with what they call robust growth in biofuels and, crucially, natural gas liquid supplies. NGLs. NGLs include things like ethane and LPG, propane, butane. They're increasingly important, not so much for direct fuel, but as petrochemical feedstocks.
Petrochemical feedstocks, meaning?
They are the essential building blocks for plastics, fertilizers, and just a vast array of chemicals that underpin modern life. Everything around us, basically. And global NGL production is expected to rise by 2.0 million barrels per day by 2030. That accounts for nearly half of all global liquid supply gains over the period. It's huge.
Half of all supply gains coming from NGLs. Wow. Who's producing them?
Yeah, it's a big share. And this growth is overwhelmingly dominated by the United States, Saudi Arabia, and Canada, reflecting their vast natural gas resources, where NGLs are often co-produced.
So refineries are adapting then. They're producing less traditional transportation fuel, while NGLs are taking over a significant chunk of demand for these other equally critical industrial uses. But wait, despite this weak demand projection for traditional fuels, our sources mention a substantial amount of new refining capacity still coming online. Why build more refineries if traditional demand is declining?
Exactly. That's another layer of the paradox, isn't it? Despite weak demand projections for those traditional products, a substantial 4.2 million barrels per day of new refining capacity is expected globally by 2030. And it's primarily concentrated in Asia, specifically in China and India.
Okay, new refineries in Asia.
Right. And this new capacity far outpaces the shutdowns that are occurring in older, less efficient refineries, say in Europe and the US. So what this means is that net capacity growth will far exceed refined product demand. That leads inevitably to lower utilization rates globally, refineries running less full. Or it necessitates even more widespread closures, especially in high-cost regions like Europe and the U.S. West Coast, where environmental regs are stricter and operating costs are higher.
So pressure on older refineries, how is the industry adapting overall then?
Well, the refining industry is clearly adapting by shifting its strategic focus. They're moving away from purely producing transportation fuels and towards building these large, integrated crude-to-chemical complexes. These facilities are designed to efficiently convert crude oil not just into gasoline and diesel, but directly into those petrochemical feedstocks that NGLs also supply. It's a really fundamental reorientation. It reflects the changing nature of oil demand itself, moving, from your car's gas tank to the materials that make up countless products all around you.
Today, we've certainly unraveled a complex web of energy trends. From China's fascinating dual-track strategy of expanding both EVs and coal power, to the surprising resurgence of U.S. oil demand projections due to slowing EV adoption, and this global refining industry grappling with a really uncertain future, defined by booming demand for petrochemicals and NGLs. It's undeniably clear that the energy landscape is far from a simple linear transition, isn't it?
Absolutely. What's truly fascinating here, I think, is how interwoven all these things are. Economic realities, strategic policy decisions, rapid technological shifts. They all create this multi-layered picture that just defies simplistic narratives. Our sources reveal a world where traditional energy sources continue to play a vital, evolving role. Even as new technologies emerge and shift the focus within the oil industry itself, it really seems to be about adaptation and diversification, not just outright replacement anytime soon.
And that leaves us with a truly provocative thought for you, our listeners. As you observe global energy news, as you read discussions around climate and fossil fuels, how much of what you read or hear truly reflects this intricate, often contradictory reality we've explored today, and how much might be simplified to fit a prevailing story, potentially missing these crucial nuances? Keep digging, because the true picture of our energy future is almost always more complicated, and, as we've seen today, often far more interesting than the headlines suggest.